If you're getting a federal refund of $500 or more, you might qualify for a refund advance loan from First Century Bank, NA, facilitated by Intuit TT Offerings Incorporated. No interest or loan fees, but eligibility criteria apply. Loan repayment comes from your refund. Funds are deposited into a Credit Karma Money Spend account. In this video, we will provide you with 5 ways to reduce your tax liability, pay no more than you owe, and maximize your tax refund. Before we continue, if you're new to this channel, please make sure to subscribe and press the notification button so you can be notified when we upload new videos. Maximizing your tax refund involves a combination of strategies, including 1. Review your W-4. Adjust your W-4 withholdings to ensure the correct amount is being deducted from your Paycheck 1. The amount that your employer deducts from your paychecks to pay federal taxes is shown on your Form W-4. To prevent paying too much or too little in taxes, you must take note of it. Overpaying results in a tax refund since you are lending the government money at no interest. On the other hand, underpayment may result in fines or tax obligations. Update your W-4 regularly to make sure you're paying the correct amount, particularly following significant life changes. Reducing the likelihood of having to pay taxes or getting a sizable refund is the goal. Your withholding is crucial if you depend on a sizable refund each year because it directly influences the amount of your refund. 2. Choose the right filing status. Your filing status, for example, single, married, filing jointly, head of household, can significantly impact your tax refund. It's essential to choose the correct filing status based on your circumstances, as it directly affects your tax obligations and potential refunds. Keeping your filing status updated, especially after significant life changes, ensures accurate withholding and compliance with tax regulations. There are 5 main categories for federal income tax purposes: single, married filing jointly, married filing separately, head of household, and qualifying widow or widower with dependent children. Each status has its own set of rules and implications for tax liability. For instance, single filers are unmarried individuals, including those who are divorced or legally separated, and they have lower income limits for certain exemptions. Married couples have the option to file jointly, which often results in a larger tax refund or lower tax liability. Conversely, filing separately might be advantageous in specific scenarios, such as when one spouse has considerably lower income or if there are significant itemized deductions. Head of household status applies to single or unmarried taxpayers who provide over half of the household expenses for qualifying family members. This filing status typically offers lower tax rates compared to single filers. Finally, qualifying widow or widower with dependent children status is available to surviving spouses for 2 years following the year of their spouse's death, allowing them to claim similar benefits to married filing jointly. 3. Claim all eligible tax credits. Tax credits such as the Earned Income Tax Credit and the Child and Dependent Care Credit can reduce your tax liability and potentially increase your refund. If you're paying for child care while working, you could qualify for the Child and Dependent Care Credit, reducing your tax bill significantly. This credit directly lowers your taxes, offering relief for child care expenses. Eligible expenses cover care for children under 13, spouses unable to care for themselves, or other dependents. However, there are restrictions on who can provide care and additional criteria to meet, including earned income and filing jointly. For tax year 2023, allowable expenses range from $3,000 to $6,000 with credits varying from 20 to 35%. Notably, the American Rescue Plan made significant changes for 2021, expanding eligible expenses and increasing the percentage of expenses eligible for the credit. While the credit is beneficial, you might save more with employer-sponsored pre-tax child care benefits. Exploring these options And understanding other available tax breaks for parents can optimize your savings. 4. Itemized deductions. If your itemized deductions exceed the standard deduction, itemizing can lead to a larger refund. Itemizing deductions offers a way to decrease taxable income, potentially leading to significant tax savings compared to taking the standard deduction. By itemizing, taxpayers can claim a higher deduction amount but must complete a Schedule A form and keep records of expenses. Common itemized deductions include mortgage interest on up to 2 homes, state and local income or sales taxes, property taxes, medical and dental expenses exceeding 7.5% of adjusted gross income, and charitable donations. While miscellaneous deductions like work-related travel and union dues were deductible before 2018, federal tax changes eliminated them, though some states still allow such deductions. To itemize deductions, taxpayers must file Form 1040 and list their deductions on Schedule A. They then subtract the total deductions from their income to determine taxable income. However, it's essential to consider whether itemizing outweighs the standard deduction for your filing status. Otherwise, you may end up paying more in taxes. Additionally, the alternative minimum tax or AMT may limit certain deductions for taxpayers subject to it, such as interest and home equity loans and state or local income or sales taxes. 5. Contribute to your retirement plan. Contributions to certain retirement plans can be deducted from your income, reducing your overall tax liability. 401k plans, established by Congress in 1986, aim to encourage retirement savings among employees for for-profit businesses. There are 2 main types: tax-deferred 401k and Roth 401k. Tax-deferred 401k plans allow employees to contribute a portion of their salary before taxes are deducted, reducing their taxable income. While contributions grow tax-deferred, taxes are paid upon withdrawal during retirement. On the other hand, Roth 401k contributions are made with after-tax income, meaning withdrawals, including earnings, are tax-free if certain conditions are met. The choice between tax-deferred and Roth 401k depends on individual circumstances, with those anticipating higher tax rates in retirement often favoring Roth 401ks. Both types offer potential tax benefits, such as reducing taxable income and maximizing retirement savings. Additionally, taxpayers may qualify for the Savers Credit, which directly reduces taxes based on their 401k contributions. Annual contribution limits and options for those aged 50 and older are adjusted by the IRS. Remember, it's important to consult with a tax professional or use a reliable tax software to ensure you're taking advantage of all possible deductions and credits. Also, keep in mind that a larger refund means you're overpaying in taxes throughout the year. Some people prefer to adjust their withholdings to get more money in each paycheck rather than a large refund. Please note that the tax laws can vary by location and individual circumstances, so it's always a good idea to consult with a tax professional for personalized advice. Thank you for watching. If you're new to this channel, please make sure to subscribe and press the notification bell so you will be notified when we post new videos.